Hello, everyone, and welcome to Nova's presentation, Common 401k Plan Errors. Today's presenter is Steve Vest. If at any time you have any questions for our presenter, you can spot the icon with a question mark at the top of your screen. This is where you'll enter any questions you have for him. Feel free to submit your questions at any time. If time does run out and you still have questions, you can send them to our email address, webinars@nova401k.com. Right next to the questions, you're going to see a paper icon with the paper clip attached to it. This is where you're going to find today's material in PDF form. If you are unable to view or click on the handout, you can go ahead and email us and we'll provide you with that PDF. If you are with us today to earn our continuing education credits, please be sure to stay until the very end to fill out the pop-up survey. This is going to allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, and that is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us today. I would now like to introduce Nova's VP, Steve Best.
All right, good afternoon, everyone, and thank you for attending our webinar on common 401k plan errors. A couple of housekeeping items here. Again, this is this disclaimer. This is not an information webinar that's meant to substitute for legal or tax advice. And if you need that kind of advice, please consult either an attorney or an accountant as necessary. Also, here's our provider number. In order to receive credit, if you're a CPA, you need to have registered individually, be present for the entire webinar, return an evaluation form, and then you'll receive your certificate within 1 week. So a few objectives. This webinar really is about a compilation of the more common errors that we find in our practice that our clients make, as well as some of the more common errors that the IRS has also identified. When they go into audit plans, they've put together a list of some of the 12 most common errors. So it's kind of a mix of both, but some of the objectives we want you to learn are how to identify who's a fiduciary in the plan, how to identify some of these common errors so we can try to avoid them, right? And then also learn how to correct some of them, because pretty much any kind of error in a 401k plan can be corrected. It usually involves some time and money perhaps, but everything can be fixed. It's just a question of how to do it. So, quick overview of the service model that we use here at Nova. We use what we call an unbundled model, so we partner with other firms to provide all the service to your plan and to you as a company. But the 4 distinct roles are the plan sponsor, which is your company. You decide you want to have a plan. Your primary responsibilities involve, enrolling people into the plan in a timely manner, sending in the contributions that come out of your payroll system to the investment provider. And we partner with quite a few firms, more than 10 or 12, John Hancock, Empower, Principal, just to name a few, Voya. But those companies are the ones that receive the money. They provide the record-keeping platform and the investments that the money goes into, and then participants can move that money around within a set menu of mutual funds. And it's that company that also handles the money out transactions, distributions. They provide the internet access for everyone to view their accounts and send out the benefit statements and so forth. So they're the money processing guys, if you want to think about it that way. Then all of these plans are heavily regulated by both the Department of Labor and the IRS. And so as a TPA, a third-party administration firm, which is what Nova is, our job is to make sure that your plans comply with all of the different rules that those agencies mandate. So we prepare and maintain your legal plan document for you and send it out for signature when there are required updates. There's a variety of non-discrimination tests that we perform every year that are required. There's an annual filing that goes to the Department of Labor that looks like a tax filing. It's really an information filing, but it does have to be filed every year. And then we provide just general ongoing consulting regarding these rules to you as a company. And then finally, neither the investment provider or our firm is able to really provide specific investment advice to your participants. And that's where your financial advisor comes into play, right? They can help if you've got individual participants that need more help on how to allocate their funds within this mutual fund menu at the investment provider. That financial advisor can often get involved with enrollment meeting coordination and provide investment and education because they're licensed to do that kind of work. Okay. So again, why is what we're talking about important? What we find is that although sometimes there's a emphasis in the news on fiduciary issues regarding the investments, what we actually find for smaller to mid-size plans and firms, it's operational issues that create more damage or create more losses to the company, where your companies have to make up contributions to individuals that are in the plan due to errors that are made. So operational issues reference not following your plan document, your legal plan document in practice, right? And that's what an operational issue really means. And for smaller companies, it's those types of errors that cost more than any kind of problems with the investments, where participants may sue the company or the investment provider because of some issue with the investments. So the Department of Labor and the IRS both regulate the plan, and both are usually collecting quite a few millions of dollars in restorations to plans due to errors. This is just some of the type of money that's involved, and it's usually going up every year because there are more and more plans every year. Also, the IRS has also increased the penalties, and the Department of Labor. It used to be much lower, but now they've gone up by almost 100% and we do see failure to file the 5500, which is the annual return, for example. If that's not done timely, quite often we see penalty notices coming out from the IRS of $30,000, $40,000 or more sometimes for a failed 5500 or a late 5500. And so we don't want you to have any of these problems, and we want you to learn how to identify these problems so they don't occur. Now, everything, as I said, can be fixed. There are several programs with the IRS available to correct errors. Some are self-correctable, meaning you don't have to have a formal filing that you submit to the IRS. Other errors are a little more serious, or maybe they're not standard corrections that have been identified by the IRS in their correction program, which might involve the voluntary compliance filing, which is a formal filing with the IRS and does have a filing fee associated with it. And then the third part of the IRS correction program is that if you happen to just randomly be audited before fixing a problem, and the IRS kind of catches you out right there, then you're correcting the problem under their audit cap correction program, and that one usually involves just higher penalties than anything that would be available in the self-correction or the VCP program. So the filing fee, if you had to do a VCP filing with the IRS to fix a problem, is based on how much money is in your plan. For those under 5,000, up to 500,000, is $1,500 filing fee plus Nova's cost to actually prepare the filing, and then plans between 500,000, 10 million, or 3,000, and then the very large plans are 3,500. So who is a fiduciary? There are three types, and we're not going to really focus on the investment-related fiduciaries, which are the 321 and 338 fiduciaries. We really want to focus this presentation on the what we call the 316 fiduciary, who is the plan administrator of the plan. In general, though, a fiduciary is any individual who exercises any discretionary control over the plan administration or over the plan assets, or renders investment advice to the plan for a fee. Okay, so again, we're not going to really talk about the third item here, but we'll talk about who actually exercises control over the plan, and those people are going to be fiduciaries. Just to list a few, your investment advisors, the trustees who are named in the plan. All plans usually name a trustee. The investment managers. If you happen to have an administrative committee that makes decisions regarding plan changes, plan amendments, plan operation, everybody on that committee is a fiduciary. Also, the plan administrator, the day-to-day person that is working at your company that signs off on loans, distributions, those types of transactions, right? Like they're approving them. Those individuals are fiduciaries. And anyone at the employer, like the owners of the company, who hire any of these individuals, right, which again are typically going to be the owners of the company, they're also fiduciaries. So again, specifically the 316 fiduciary is the administrator of the plan. Okay, they're not usually named in the document, and so when they're not named in the document, then the person who's responsible for managing the daily operations of the plan is that person, or it might be a team of people. But since there's no one named, it's whoever that task has been assigned to. All right. So normally you would think, well, isn't Nova handling the plan administration, or my investment advisor? My investment company. Aren't they the 316 fiduciaries? Now, in Nova's case, the answer is no, because we provide just ministerial functions, and we don't take over. We're not making decisions for you. We're preparing forms. We're preparing testing for your review. We may be involved in preparing or reviewing loans, right? But we don't approve those things, right? Someone in your office typically approves those things. And so we're actually not a fiduciary. We're sort of like the CPAs that are preparing the tax return, but the individuals signing it actually are the people that take the ultimate responsibility. So some of the duties of a plan administrator involve distributing annual notices, distributing the summary plan descriptions, the SPDs. Again, these are the layman's explanation of the plan provisions in written form that are given to participants that correspond to the legal provisions in the legal documents. Okay, you're involved with approving loans and distributions, maintaining the legal plan documents, meaning signing them. Again, Nova helps you prepare this, but it's technically the plan administrator's responsibility to make sure it's up to date. So. But these are some of the examples of plan administrator duties. So we'll get into some of the more common errors. So the first one is the failure to amend the plan for current law changes. And as some of you may have seen from emails and correspondence from our firm and some of the investment providers, there have been quite a few law changes in the last few years. The Secure 1.0 and 2.0 acts changed a lot of provisions that 401k plans have to conform to. And whenever these laws are changed by Congress, the IRS usually approves they approve pre-approved documents, right? So all the document writers try to incorporate these new rules into the documents. They update them. The IRS approves them, and then everyone in the country basically has to adopt an updated plan document every 6 years or so. The most recent restatement cycle, as we call it, right? This restatement to the brand new documents occurred in 2022. And again, NOVA does keep track of these deadlines. When the documents become available, we communicate with you and let you know if there's a restatement that has to be signed by a certain deadline so you can get it done on time, right? So it's not that you have to track all of that yourselves, but you need to be aware that when we send out emails saying, hey, there's an amendment required, it needs to be signed by this date and so forth, um, that needs to be done. Oops, hold on a second. Yeah. So another type of document failure is the failure to sign up all of your affiliated employers. Okay, so in the documents that NOVA uses, only companies that have executed a participation agreement, kind of a sign-up agreement to the plan, are permitted to participate in the plan. So you may have other related companies that are part of what we call your control group that generally would need to be included in the plan, or you might be offering the plan already, but they don't have a participation agreement. We've got a legal plan document issue we have to solve for, right? So you can't have 4 or 5 companies and only one of them is signed up for the plan, right? You'd want to sign up all 5. So which companies really do need to be signed up? Those are the ones that are within the same, what we call, control group. All right, and they generally should participate in one plan. And a control group is any company that owns at least 80% or more of another company. That would be considered a control group. Or if you're dealing with individual owners, right, if the same 5 or fewer people commonly own 80% or more than one company, then those companies are in a control group as well. So if it's me and another person owning 3 companies, right, 50-50, all those companies are in the same control group, and the IRS generally looks at all those companies as if they're one company for purposes of participating in the plan. So again, how do we avoid having problems with the amendments and not getting them done on time? Just make sure you're reading our correspondence carefully. We try to send multiple reminders when something is due. We may even have your account manager call you if we're not getting responses to the emails. So we do everything we can so the deadlines are not missed. But if you're aware of other companies that are part of the same control group that I just described, and they're not either participating in your plan or they don't have a participation agreement, a sign-up agreement, then please call us immediately. Also, if there's ever any kind of sale or purchase transaction of another company, please contact us because we can help you work through the options that are available anytime you buy and or sell a company and how that affects the plan, because there could be some significant impacts on your plans when those types of transactions occur. Okay, and then just pay attention to the emails and make sure that all the amendments and restatements of these documents are done on time, and that can avoid having to do a VCP filing to fix the problem. Again, if you miss a deadline, it can be fixed, but now you're probably going to have to file with the VCP program and pay some of those filing fees plus our costs to prepare these filings for you. So failing to follow the provisions of the plan document is a very basic operational problem that we run into. But the key idea here is it's your legal plan document that matters. Whatever's written in there in terms of what the eligibility is, the vesting, who's allowed to participate in the plan, it's that document that matters. Okay. And the IRS reserves the right to disqualify any plan that does not follow its written terms in actual practice in the real world. Okay, so what are some of the types of problems in following your plan document? Again, compensation is one of them. Failing to follow the definition of compensation. What compensation is available for salary deferrals for your participants? What the matching contributions are based on is defined in your plan document. All right, and most of NOVA's plan documents would generally define compensation as gross compensation, right? But sometimes employers are not aware of what's in the document, and they're following a different definition of compensation, like maybe one that excludes bonuses, right? So again, what compensation am I basing all the elections on? If I'm a participant and I say take 10% out of my pay, it's like 10% of what? 10% of gross comp, 10% of some sort of net compensation that's net of bonuses. What you're doing in practice has to match up with what your document excludes or doesn't exclude, right? So, and if there's a mismatch there, then some participants may be receiving incorrect allocations of the matching and employer contributions if you're making one, or their employee contributions may be deducted improperly as well. Most of our plans, as I said, define compensation as total gross W-2 pay, and excluding bonuses, commissions, overtime, any number of other items is possible if your document indicates that those items are excluded, right? There are check boxes that say what's excluded and what's not. And some of those exclusions also would require some specialized testing for NOVA to make sure that it's not discriminatory. But again, this idea of what does your document say and what are you actually doing in practice is the important concept here. If you're not sure what your document says, please contact your NOVA account manager, and they can verify, okay, your definition of comp that you're supposed to be using in your payroll system is X, right? So just some examples, right? If you have a company that adopts a matching formula and their payroll system calculates the formula based on a base pay, right, that excludes overtime and bonuses, but the document says something else, like it's based on total compensation, we have a problem because you have to do what the document says. And so if you've been excluding some items of pay, that's a correction that NOVA would have to come in and you'd give us the excluded pay going back as many years as it was being excluded. And we now have to calculate, the missed deferral or the missed contributions the employee should have been allowed to take from those excluded items, right? And then give them those amounts plus earnings, generally is the correction. So the company would have to make most of that money up to the participant. It's not the participant that goes back and fixes it at that point. So again, it's a matter of cost. Again, to avoid this problem, please be aware of what's in your plan document. Especially every time if you make a change, an amendment, because these documents can be amended from time to time to change what your definition of compensation is, as well as many other provisions. Somebody needs to be keeping track of, what is it that the document says. And if you're not sure, just call us. We can help you out with that for sure. Also, if you've got different personnel changing over in HR that handles payroll, they need to be trained properly on here. What matters is not the offer letter that you might have given someone. What matters is what's in this document, right? You can't change the terms of the document by honoring an offer letter, for example, that said that, oh, we're going to let you into the plan early, or any number of provisions that might be in those offer letters. So again, well, like as I was saying, it's not the admin policy or your offer letters or anything that determines what's important here. It's that legal plan document. And we do find that, again, one of your primary objectives and purposes as a plan sponsor is to make sure that your newly hired employees are offered the plan in a timely manner. And sometimes employers don't let people in on time, and sometimes they let them in too early, right? We've seen both situations. Quite often it's usually, they've been held out improperly. And again, that creates a problem we have to fix. So understanding, what your initial waiting period in your plan is very important. So for example, if you have a company that has no agent service waiting period in it, and all of a sudden one of your employees, Steve, is not offered enrollment in the plan for 6 months, then we've got a problem we have to fix. And again, it's going to involve getting the compensation for that 6-month excluded period and making up missed contributions, the employee portion and the employer portion that they would have been eligible for. And you're probably asking, well, they didn't even make an election, but there are ways that the IRS requires a deferral rate to be calculated, like it's usually the average rate of everyone else, for example, is what you would use to give Steve and then make him whole, so to speak, right, for this missed exclusion period. Just some background on initial eligibility. In a 401k plan, the maximum waiting period you can have by law is 1 year of service and age 21, so you can't have a higher age limit than 21, with a minimum of 2 entry dates. Okay, so typically most plans are calendar year plans, right? And so 2 entry dates would be 1/1 of each year and 7/1. So semi-annual is the maximum. So a certain number of hours may or may not be required in order to accrue that 1 year of service, but most plans use 1,000 hours. So if you work 1 year and you work 1,000 hours in that year, then you qualify for a year of service. And you can't require more than 1,000 hours either under the law. All right. Now the last item, I'll go over a visual here because it's a little hard to conceptualize, but it is important that you understand how the 1 year of service waiting period works, because a lot of you on the phone probably have a 1 year waiting period, and you need to know how to calculate that properly, let your people in on time. But the initial computation period is the 12-month anniversary date from the original date of hire. And then if they don't qualify in the first 12-month period, then the next computation period for determining if they work 1,000 hours typically changes to the calendar year or the next plan year, right? So most plans are calendar year. I'm using a calendar year example. So what that looks like here, if I have somebody that hires 6/1 of 2022, I go to the 12-month anniversary date, which is 6/1 of 2023, and I ask the question, did they work 1,000 hours in that period? Yes or no? If the answer is yes, right, and again, I've got 2 entry dates, so my entry dates are 1/1 and 7/1. So the person actually gets credited 1 year of service on 6/1 of 2023, and because they're past the first entry date in the year, they go to the next entry date, you would offer them the plan for pay periods after 7/1 of 2023 in this example. All right. Now, if the answer is no, maybe they worked 500 hours, all right, in that first computation period, then to make the computation a little bit easier, because as you can see, the first one is required by law to be the 12-month anniversary date, which is going to cross calendar years, right, in most situations. So to make it a little easier to figure out on the next computation period if they didn't make it on the first one, right, it switches to the calendar year. So for the second, let's say this person was at 500 hours in the first, you go to the next year, you go to the calendar year, and then you ask the question again, did they work 1,000 hours in that period? Right? And if it's yes, they would be credited with 1 year of service on 12/31/2023 in this example. Right? And then they'd come in on the 1/1 entry date, 1/1/24. So that's how the 1 year work 1-year wait works with semi-annual entry dates. So shorter waiting periods are okay. We have a lot of plans that have either immediate eligibility, so the minute somebody's hired, they're in. 3-month wait, 6-month wait. You can have those shorter periods, not a problem. Those are a little easier to calculate because there's no hours required for those types of periods. They're done on what we call an elapsed time basis. So what that means is, again, in the same situation, I start with the original date of hire. And if I've got a 3-month wait, I just go to the 3-month anniversary date. And if the person's employed on that 3-month anniversary date, they're in. They could have worked 1 hour at the beginning of the period and 1 hour at the end, and it's as if they worked all 3 months. It's called service spanning, right, for these shorter periods. And it's not effective for keeping your part-timers out, right, because it's not based on hours or anything like that. So, for example, if we have a company that's excluding hourly employees, so this is another type of problem, excluding classes of employees, right? Again, when your document doesn't indicate that you're able to do that. So, for example, if I'm excluding hourly employees from my 401k plan, my document has to be written to exclude hourlies. Again, there's a checkbox for hourly employees are excluded, right? And if it doesn't say that, then I've got a problem. I've excluded people improperly from the 401k plan. Also, there are limits to how many people can be excluded by classification as well. Generally, it's only about 30% of your non-highly paid people. So there are limits. It's not like you can say I'm going to exclude everybody but the owners, or something like that. So another popular type of exclusion is to exclude part-time or seasonal individuals. The IRS does not like part-time or seasonal exclusionary language in the documents because you can have part-timers that get to that 1,000-hour mark. That's the statutory limit. Like we said, the maximum limit is 1 year of service with 1,000 hours worked in that 1 year. That's the maximum. And you can have part-timers that get to 1,000 hours. And so to exclude them based on service classification like part-time or seasonal, the IRS views as a way to circumvent their maximum 1 year period. And so they don't like service-based exclusions in documents. They don't like it so much that the new regulations for what we call long-term part-time employees under the Secure Acts has come to pass, and that's an entire webinar on its own. But in general, what it is if you've got the same part-time people working, let's say 2 consecutive years, working between 500 and 999 hours for 2 consecutive years, you have to let them into your plan for employee contribution purposes, even if you have a 1 year wait, right? They didn't get to the 1,000 hours. Now you can't even exclude them. Again, people who work less than 500, okay, that's still okay, but you have to watch these long-term part-time employees. If you think you have anybody like that, again, it's like for at least 2 consecutive years, they have to have worked between 500 and 999 hours, and you didn't let them in. Your plan already doesn't let them into the plan, right? Like a 3-month wait plan would not have to worry about this because they should have come in anyway under the terms of the plan. But if you think you have a problem like this, call your account manager and we can take a closer look at your information, the history, the hours worked, and so forth to see if there are any problems. So how do we avoid this? Again, you need to be very aware of where are the eligibility waiting periods in your plan, the entry dates in the document, so that you're letting people in on time. And don't be excluding any particular classes of employees that aren't mentioned in the document. So you need to be aware of what's in there. a lot of companies, because their health and welfare benefits might exclude part-time employees, think they can do it in a 401k plan, and that's not the case. It all depends on how your document is written. Also, as you're enrolling people, in case of an IRS audit, it's always a good idea to collect any kind of declination of participation form. So when you're offering the plan to people, even if they elect zero, like I don't want to participate, if you can get some sort of confirmation of those zero elections, so you can prove to the IRS that you did offer the plan to people on time, that's great business practice. And we get a lot of questions dealing with rehires. What do we do with the rehires if we had a formerly employed person? So it's a little easier. The easiest way to think about it is if a formerly eligible employee ever had a single dollar in the plan, their money, match, it doesn't matter, employer money, if they've ever had any money in the plan, then they never lose their prior service credits. And again, vested money, right? Meaning, on the employer side, they're not 0% vested. But now, if they'd never had any money in the plan and they've been gone for 5 consecutive years, then you restart them at that point. But that's a pretty rare circumstance. So normally you're rehiring people within this 5-year period, right? And so they don't lose their prior service credits. If they were formerly eligible and they come back, you don't even wait for the next entry date. You just let them in immediately. So that's how you handle rehires. There's also, just so there's no confusion about, we talked about what is the service crediting for initial eligibility. There's also service crediting for vesting, which works a little bit different. By law, service for initial eligibility, as we've talked about, must be credited from the original date of hire, not a date of rehire or anything else, right? For vesting, it's computed on a plan year basis. So if your plan year is calendar, which most plans are, you're looking at the number of hours worked on a calendar year basis. So there's also service accrual for receiving the employer contributions. You can, even if somebody was eligible to contribute employee money, you can put additional conditions on, when they can receive the employer money. So some plans require that a year of service be credited in the year that you're making a contribution. And you don't want to confuse that, with initial eligibility. It's different. The person's eligible, but you might have a requirement in your plan that, they work 1,000 hours in the allocation year to get the money, the employer money. These types of provisions don't work well on a payroll by payroll type funding, right? Typically, you'll see these kind of rules if you're funding all your employer contributions annually. All right, so loan provisions. Loans are very popular in plans, and it's a way for employees to get some of their money out, not have it be taxable, but they are subject to certain rules. So loans, we can have problems with loans if they exceed the maximum dollar amount that's available, and we'll go through some of these rules in a minute. Excuse me. Loans have to follow amortization schedules. Sometimes the payments are not started on time in payroll, which can produce problems. So anytime the loan rules are not followed, and we'll go through a couple of examples of those, then the loan becomes delinquent. So the most common problem we run into is somebody took a loan and the loan is not started on time in terms of deductions for the loan repayments in payroll, right? So when that happens, the loan becomes delinquent and it has to be cured or kind of brought current within a certain time frame, and that time frame is the quarter after the quarter in which the first payment is missed. So if I miss a payment or my loan is not started on time in the first quarter of this year, I have until 6/30 to fix that problem, right? Otherwise, the loan becomes taxable after the cure period, right? So in a loan situation, participants are borrowing their own money, and then they're paying the loan repayments go back into their account. They're paying themselves back, right? But that whole transaction of the loan is not considered a taxable distribution, even though they got cash out of the plan, right? The minute the loan becomes delinquent and is not fixed, then it does become taxable and is treated as a distribution, which can create some hardship for the participant because now they've got extra taxable income that didn't have any withholding, and when they go file their taxes at the in the following year, they're going to owe money, right? So some of your investment providers will let you know and have reports that are available online that tell you when a loan is delinquent or behind. So you need to pay attention to those things. Um, so how do I fix a problem loan or a delinquent loan? So before the cure period ends, you can either catch up the missed loan repayments. The individual, if they wanted, could completely pay off the loan in full, right? Or with our help or the help of your investment provider, we can help you refinance it or re-amortize it, right? Because they've missed maybe 10 payments. There's a way to re-amortize it so the loan is paid off on time, right? After the loan cure period ends, though, it's the IRS requires that the loan be defaulted. It could be corrected within certain rules, even after the cure period, using one of the IRS's self-correction or voluntary compliance correction programs. So there is some availability for a fix after the cure period, but you really want to be catching these things during the cure period as much as possible. So again, try to make sure you're monitoring your investment provider websites and messages. They send out a lot of messages, especially if there are problems with loan transactions and so forth. I would also periodically review your investment provider information. This is the vendor, right? So they have reports on who has loans. So you can print those or order those and then compare those to your payroll records to see if they match up. Right now, there might be some people that terminated that have loans at your investment provider that are obviously not on payroll anymore. But you should be able to reconcile that and make sure that everybody that's actively employed with a loan has a loan deduction coming out, right? Because if they don't, you've identified a problem, right? So generally, to make this a little bit simpler to track, we only allow one loan at a time for a participant per our plan documents. Technically, there's no limit. I mean, somebody could have like 4 or 5 different loans, but we try to design our plan documents to avoid that kind of complication. Another very common problem is the failure to deposit the employee contributions and loan repayments on time. This is a big DOL audit issue, the one they care about the most. Part of your responsibility as a plan administrator is when the deductions are taken from payroll, they need to be sent in to your investment provider, whether it's John Hancock or Empower or whoever, within a certain time frame. Now, if you're a small company with effectively less than 100 eligible people, the DOL created a safe harbor time frame that's 7 business days after the pay date. Okay, so you have to get the money over to your investment provider within that time frame, or they're considered late. All right, this doesn't apply to your employer contributions. This is the employee money, whether it's a loan repayment or an employee contribution deduction. All right. Now, the large plans have a more nebulous deadline, right? It's basically as soon as administratively feasible, but not later than the 15th day of the month following the pay date. That second bullet you can just scratch out. That's technically what's in the regulations from the Department of Labor, but we know that they're looking at the as soon as administratively possible rule. Okay. Now, what does that mean? They are they are going to look at all of your other administrative procedures, like how soon are you sending in the withholding on that same pay date, for example, right? Like if you're sending in withholding within 3 days of the pay date, and you're holding onto the employee money for the 401k plan for 2 weeks, that's going to be your standard is going to be 3 days. It's not going to be like 2 weeks or 3 weeks. So it's not a bright line test, but I can tell you in general from the audits we've seen, you get about 3 to 5 business days as a large plan. But it could be less than that depending on your practices. So what happens when the contributions are late? And we deal with this a lot. This is probably one of our biggest problems. We have to do late contribution, late earnings on. We have to calculate investment earnings on the late contributions, right? And then those get deposited into the plan. So you owe them money for holding onto the funds for the employees, right? And it's also when late contributions happen, they're reportable on the 5500, which goes to the Department of Labor, and now you're subject to potentially a higher audit risk, right? In addition, they're considered prohibited transactions, so there's an excise tax that has to be paid. Generally, the amount of interest and the excise taxes involved with late contributions, if you're only a few days late, is not a big number, but the calculation is more complicated in the preparation of the form. What we have to do to fix it and do the calculations often costs way more than what you actually have to put back in the plan. So it's better to just avoid it altogether. So just identify, am I a large plan or a small plan, and what is my applicable deadline, right, for getting my contributions in, and just set up procedures to make sure that those deposits are being made by that date. Always have a backup in payroll. I know a lot of you probably have small companies. There should be some sort of a backup for if somebody's out on vacation or sick leave, like to make sure that these submissions of the contributions are going from your payroll over the investment company. We would recommend what we call 360 connections, right? This is where you can work with your investment provider and your payroll company. Many times there's a way they work together and they can feed information to each other automatically, so that there's no individual involved in hitting the approve button every time you have to, send the deposit in for a particular payroll's contributions. The other thing is to be consistent, right? You don't want to be sending in some payrolls within 3 days and the other payrolls within 4 days or 5. Try to make it a certain standard for your company so it's always the same. And then the Department of Labor can't come in and say, well, you got this one in 2 days, and all the rest of them are 5 days, so all the 5 days are late, because they can do that. So another common error is what we call source corrections, so depositing contributions into the wrong money source or bucket at your investment provider. All right, so employee contributions can be pre-tax. You have Roth, matching, profit sharing, safe harbor contributions, right, which are always 100% vested. So because the vesting and some of the distribution rules within the plans are different for each of these money types, you don't want to be commingling, for example, Roth and employee deferrals together, because a Roth is an after-tax deduction, and the regular employee deferrals are pre-tax, and they need to be going into the right buckets at Empower or Voya and so forth, right? And sometimes we do have clients that make errors and they start commingling money, or they put it in the wrong type of source. The vesting can be different on all of these as well, right? Employee money is always 100% vested. Match might be subject to a vesting schedule, so you just don't want to be commingling. Now, it's important to understand what the limit on the employee contributions is for each year because it does change. So for 2025, anybody that is under the age of 50 can put in 23,500 maximum. All right, and anybody that is older than 50 or turning 50 or older in 2025 can put in an additional 7,500 for a total of $31,000. Okay. You add your Roth and your pre-tax together to determine this limit. It's not a separate limit. So when you add all your employee contributions up, it's one of those limits, right? Now there's a new limit as well, just to complicate matters, for 2025, which is part of the Secure Act. So participants now that are age 60 to 63 can contribute. Their catch up is higher than everyone else's. They can put in 11,250. All right. Now this is an optional provision, but it's one that benefits the employees. So NOVA documents will be written to include it, unless you call us and you want to amend that out for some reason. Now, it is important too to have your payroll systems update or check with them, right? If you have participants in this category, that the limits, right? Because you've effectively got three limits now: one for under age 50, one for anybody that's 50 to 59, and then 64 to on up, right? I mean, and then this middle range here, that's a totally different limit, right? Like, is your payroll system set up to handle something like that? If you're not sure, I would ask them, because this is in effect this year. So, and I'm sure you want to communicate this special limit to some of your 60 and 63-year-olds, or 60, 61, 2, and 3. So a 4-year age range there. Let's see how we're doing on time here. Okay, we're good. So there's also a matching limit that's important to set up in payroll, right? So you've got your employee limits that we just mentioned. Effectively, if you're making a matching contribution, so if you're some plans are discretionary, and if you've got a discretionary matching formula, you don't need to worry about this. Like, and you're not putting in any match because it's discretionary. But if you're actually making a match, be aware that there's a limit, and it's due to the fact that there's an annual compensation cap. This is an IRS mandated limit each year. On the total, the maximum amount of compensation we can count for 401k purposes. All right, for 2025, that limit is $350,000. So when we're running all of our testing and matching computations, and of course, if you're having your payroll system do the matching computation, it applies to that as well. But we cannot count comp in excess of 350. So you could have somebody making $1 million, and we're not going to compute our matching formula on $1 million. It's got to be limited to 350. So what does that look like? We probably have quite a few plans that make what we call a safe harbor matching contribution, and that has a very specific formula. So 100% of the first 3% that somebody contributes plus 50% of the next 2. So because if you just do the math, right, that formula caps out at 4% of pay. So the limit, the most any person with a basic safe harbor matching formula like that can receive in any year, in this year, is $14,000. That's the limit, and we arrive at that by taking 4% of $350,000. If you happen to contribute more than $14,000, when NOVA gets your information in the following year, we can check this limit and see, oh, somebody went over it, and at that point, what we would do is forfeit or take away the excess and put it in your plan's holding account for your future use. Again, if that assumes that this individual has not already terminated and taken all of your money. Like, so if you put in $15,000 or $16,000 for them, and they left during the year and then took a distribution, there's not much we can do. I mean, all that excess that you might have recouped is gone, and you're unlikely to get it back. So please be aware of this limit. It is one that can also be put in your payroll systems if it's calculating a match, and you just put it in as a dollar amount. It's 14,000. Just base it. Take 350 times whatever your maximum percentage is in your matching formula, because not all matching formulas are this particular one, but if you've got one that caps out at 3%, 2%, whatever, just take that percentage of 350, and that'll tell you the dollar amount that's the max in your plan. So we want to make sure these dollar caps are in place for both the employee and the employer contributions in the payroll system. It's better to catch them. We are looking, again, NOVA, as part of our testing, we look at this when you give us your information, but we have to wait till the end of the year closes, and then right now, for example, we're working on your 2024 year, and we'll catch these issues and fix them. But if somebody in the interim takes the money, then that could be a loss to your company. So it's better to catch it earlier than let us do it after the fact, right? And just remember, the catch-ups and the non-catch-ups are added together for calculating your employer match, right? You don't calculate your employer match separately on your catch-up buckets, right? And then monitor the contribution limit changes each year. We send out a notice to all our clients in December because the IRS usually updates some of these limits. They do change for inflation and whatnot each year. We send out a communication to all of you through email saying, here are the new limits for 2026. That would happen in December of this year. So when you get those limit changes, make sure you're updating your payroll systems accordingly. If they don't do it automatically for you, right? And some do and some don't. So there are a variety of notices that have to be sent out. Some, at initial enrollment, and others annually. The summary plan description, again, we provide along with the legal plan document. It's like a 16-page written, plain English explanation of what the rules of the plan are that you're required to give all of your new employees. These don't come from your investment providers. None of the investment providers that I know include this. So as part of their enrollment packages. So it's usually something that when somebody becomes eligible initially, you want to give them that as well as the other enrollment materials. Now, some of the other fee disclosures, we provide the safe harbor notices. If you're a safe harbor plan, we do that again 30 days before your plan year begins. We also do the automatic enrollment. We provide those to you, right? We're not sending them out for you. The fee disclosures are typically enclosed and sent out by your investment providers. But just be aware there's quite a few notices that are required, and many of them, we are going to let you know, here's your notice for the year, send it out by this deadline, right? So, keep up with our email correspondence regarding that. Also, the forfeitures. So, again, if we have to remove money that somebody was not owed and we put it in your holding account, that account's called a forfeiture account. It also receives money if you have a vesting schedule on your employer contributions and somebody, for example, is 20% vested and they had $100, $20 goes to them and the other $80 goes into your holding account. You recoup it. So how can I use these funds, right? You can use them to reduce your ongoing plan expenses, routine ones like our bills if you're receiving a bill from NOVA. Typically, most employers will use them to reduce ongoing employer contributions. So if I'm making a match and I have some funds in my forfeiture account, I can offset some of my match with forfeitures. So maybe one payroll I owed $10,000 in match, and I've got $2,000 in my forfeiture account. You work with your investment provider, and they can ACH your account for $8,000, and then take the other $2,000 from the forfeiture account to fund the contribution. But the one thing you never want to do is make sure that you're asking for money to be sent back to you as an employer from the forfeiture account, right? That's a prohibited transaction, so never do that. So I don't know if we have questions at this point, Yvette.
And nope, no questions came in.
No questions? Okay.
Alrighty. We'll go ahead and close this out. A reminder at the top of your go-to panel, you're going to see an icon that is a paper with the paper clip. That is the handouts icon. You can click on that to find the copy of today's presentation in PDF form. If you are not able to see this, you can email us and we'll send you a handout. For CE credit, please be sure to fill out the pop-up survey once the session ends. For any other questions, you can email us webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates. Thank you so much, Steve, and thanks everybody for joining us. We hope you have a great day. Bye.